Without further ado, we've got our speaker for today who is going to be speaking on using existing equity to grow your passive income. He's a creative lender, he's an investor, he's a syndicator. Give it up for my friend and official sponsor of Music Money Investors Group, Billy Brown. Woohoo!
How many guys have rental properties right now? All right. So your equity's there, sitting there. Just sitting there. We've all seen this. Like in Nashville, the United States has grown exponentially. Not even rents have gone up because there's more people out there that need homes. But the values have gone up as well. So you're sitting on a bunch of equity, and what's it doing there? Nothing. Absolutely nothing. So we're going to talk about how to access that without selling. All right, let's just say you bought 2 or 4 identical rental properties in 2014. You paid about $200,000 a piece for them, so it's $800,000. You put your normal 20% down using a Fannie Freddie loan, something like that. Your loan amount's about $640,000 at that time. 2019 rolls around. Value's gone up. Now it's about $1.2 million. Your tenants actually have paid the loan down to about $575,000. That's $625,000 in trapped equity. It's sitting there, doing nothing. Now you can sell it. There's plenty of realtors in the room that love for you to sell that thing. But how many guys are trying to sell a property with a tenant in it? It ain't fun. It ain't fun at all. Because you can coordinate with them, see their dogs, if they're smokers, if they're whatever. You're not going to get the highest value. And then you got to sell it. If you sell one of these things, you got to 1031 or do something else with it. That's a big pain in the what. So what do you do? Well, I say this, what's your rate of return on that equity? 0? Negative. Opportunity cost. Negative, especially in today's world. All right, let's look at the math. And again, these are just for approximations here. If you guys have specific deals that you want to look at, we can get a term sheet pretty quick on these things. But just kind of give you conceptually as far as what can be done with this. So most lenders out there will lend up to 75% of the appraised value. We do have a couple that will do 80%. You subtract out your loan balance, your appraisals, your closing costs, and then down here, lender fees. I just lumped all these things together because I was running out of room. Your lender fees, attorneys, prepaid escrow, broker fees, yada, yada, yada. That's down about $40,000. The prepaid escrow thing, when you go to these things that are securitized, they want to make sure the taxes and insurance are paid, obviously. So they're going to require you to escrow them. So they're going to have that lumped in the loan as well. So easy math, cost you $50,000 to do this. $275,000. That's a lot of money. What can you do with that money? Well, first of all, typically that's tax-free. These things are 30-year amortized loans. Instead of having 4 loan payments, or if you guys have multiple properties out there that are a dozen or so, that you got to keep track of all these payments, you're tied to one payment. Obviously, the taxes and insurance are included in that thing, so you have to worry about end of the year paying those tax bills. The properties, here's the key thing. People are like, well, I don't want to strip all my equity out there. You don't worry about that because the properties still have to positive cash flow at a 1.25. And DSCR means debt service coverage ratio. In English, that means you have to have 25% more income than your mortgage payment after expenses. So you're going to have a positive cash flow. Here's the beauty of this thing. It does not report on your personal credit, and it's non-recourse. Here's the definition from Investopedia. Basically, if the property is collateral, it's got to stand on its own. Again, these things are securitized. They got to look pretty much the same, and they've got a cash flow. The reason being, if something screws up, they're going to come get the property and take the property, and they're not going to come after you for anything like less than what the property's worth. Say another 2007, 2008 happens, which is not going to happen anytime soon. They're not coming after you personally to go take you down. These things are on their own. It's pretty cool. What does that do for your Fannie and Freddie? Opens you back up because now you got no more Fannie Freddie loans on your, if you guys are lender people, on your application there, your 1003, you're just listing income and no liabilities. Same thing in your balance sheet. You get the equity from these properties on your balance sheet, but none of the debt. What does that do for your net worth? Goes up. So here it is. An asset shows up on your balance sheet, but not the liability. When that happens, guess what the lenders want to do at the banks? They can increase your aggregate limit. And then obviously reset your ability to use your Fannie and Freddie loans if you do intend to go that way. Again, not recommended unless it's, unless you got a really good relationship there. Pretty cool stuff. They just gave you a check for $275,000. Maybe more, maybe less than what you got. What can you do with this? Let me give you 3 examples here, and then you guys pipe in other ideas. Easy one is you go pay cash for a deal. And then you can refinance that with a Fannie Freddie loan. Usually do that, within 6 months, use a new appraised value and just recycle it about every 6 months. You want to jump into larger investments, which is why we're here. You can buy probably about $1 million asset or multiple properties. And if you just use cash on cash numbers when you leverage that money, that could produce you anywhere from, let's say, $27,000 to $40,000 in additional net income if you're getting 10 to 15% cash on cash. Double your assets. Almost double your cash flow. What did it cost you? Nothing. You repurpose that equity. Another strategy we have is we have an unsecured, non-recourse line of credit. The company we work with will do up to $5 million, but they'll lend up to like 80% of the acquisition. So let's just say you have this, you can probably get about $1 million line of credit to go do multiple deals. Just 3 ideas. What other things could you do with $275,000 in your city bank account? Maybe participate in someone else's deal. Maybe, want to go overfund your life insurance policy? Do what you want, whatever you want to with it. Pay off your home. Go help Bill's nonprofit out. What do you want to? So it just opens up more possibilities there for you when it comes to leverage, especially now when we think there's going to be a little bit of dip in the marketplace here in the next, probably 12 to 24 months, that we're going to have some softening and hopefully some more deals out there that are more palatable before the next ramp up. So positioning yourself for that coming downturn is a good idea. So here's the overview. Pretty simple. Usually, most people are like, hey, well, I'm not employed anymore. I may have a little credit hit for whatever reason because of, I leverage credit cards, my flips or whatever. They don't really care about this thing. Usually 640 credit score and above is pretty good. Here's some hairiness in there, but not to get too in-depth in details. Ownership structure needs to be the same across the entity that owns the properties. So if you guys are investing with other people in other areas, and it's a 40, 30, 20 split or whatever the math works out to be in different types of things, it needs to be the same across the board when you do these things. They're going to require a special purpose entity. They actually like Delaware. You guys know what SPE is? Basically allows if there's a foreclosure or a deed in lieu, they can take your property pretty quickly. And Delaware is obviously more, investor friendly, business friendly. Usually your minimum home value is going to be around $75,000. Again, here's the kind of bad part there. They're going to escrow for taxes and insurance, and they got to pre-fund that at closing. Again, these things are securitized, so they got all of the same. For this to make sense on the non-recourse world, because of the way these lenders want these things, you're looking at probably about a minimum $500,000 in equity to make this make sense. Now, if you have properties that don't have that, you can probably go to a bank lender and get something similar to go free up some equity. And they're going to be recourse, but kind of does the same thing, can cross-collateralize your properties. And then prepayment penalties. Oh, these are fun. Why do you think they have prepayment penalties on these things? They want to make money. How do they make money? Interest. So they have pro forma on their investment PPM to these hedge fund investors. They're going to get X amount of interest for X amount of years when they go buy these securitized loans. And if one of them falls out or a deal falls out, that kind of wrecks their entire package. So they want you to basically compensate them for pulling those things out. So another thing to say there is if you have a bunch of these things and you're going to go cross-collateralize them into one loan, you want to make sure that you have the ones you're going to keep inside that loan and the ones you're thinking about selling outside of it, because you don't want to be able to break these things up and have prepayment penalties. It is a giant headache. So that's another word of caution there. Cash out, 70 to 75%. I've seen 80% in some instances. We do have a gentleman in Texas we got 80% on, which is quite aggressive. Debt serving coverage ratio is 1.25. We've seen 1.2. You get a little bit higher. The larger these things are, the lower the debt serving requirements are on them. They do 30-year fixed and any variation there of an ARM that you want to. And then rates vary like interest rates, but they're very competitive. You're not talking 8s, you're talking mid-6s, if you're a good qualified borrower. But yeah, that's basically it. They're very, very simple. It's a very low doc loan versus the other, lending out there as far as like, hey, here's everything in my, on me, my kid, my dog, and I've got to write a letter of explanation on why I bought this, soda at 7-Eleven last year. They don't really care. All they care about is the property and make sure cash flows. That's it. They're going to require some tax returns just to make sure there's no other liens that can jump ahead of them. But as long as the property's appraised and your rent roll's good, it's done. They can fund these things in 30 to 45 days, sometimes faster. Sometimes in the appraisals, we got some lenders out there that I know about that will do desktop appraisals, drive-bys. Don't need full appraisals. It's pretty cool. So just an alternative way you guys think about as far as how to access funds, because the number one thing we're seeing right now is there are deals out there. You have to go buy an investment property to go make money. If your liquidity is tied up someplace, you can't access it, that's a problem. You want to be able to access it quickly to be able to jump on these deals, and here's just one alternative way to do it.